Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending December 23rd, recording this on the 24th. So Merry Christmas and Happy Holidays to everybody. We're going to take a few days off after this, but we want to dive into our weekly market recap and take a look at the price action for both the crypto asset classes as well as the traditional markets. We'll go ahead and dive right into the charts and start with Bitcoin. Taking a look at Bitcoin here, we can see that we're trading below some pretty major volume. It's acted as pretty major support and resistance. We're currently just below those levels, which is about 16,900 or so. We're also slightly below the 50-day moving average, and some of our we're just below the 10-day EMA currently as well. Currently got a short on in Bitcoin. I don't think there's a lot of likelihood that we're going to see a significant bounce from here. If we do, it will likely just get back up to that anchor VWAP position, which is currently just below 18,000. And so as long as we stay below 18,000, I'm going to keep my short on, and we'll be looking for, at some point, some sort of breakdown. We might have to be patient on this one because we could potentially see some sideways price action on this for days, if not weeks more, before we see a definitive break either way. But I do think that the highest probability outcome on this at some point will be a breakdown and likely head lower. And the price targets that I'm still looking at for Bitcoin to the downside might be some support around 14K, but really looking for that 12K level for the next potential area of support to the downside on Bitcoin. And then we jump over to the Ethereum chart. Ethereum's looking slightly worse than Bitcoin. We're actually below this trading channel, or just really right at those levels right now. 1225 to 1400 has been a channel of price action where we've kind of chopped around sideways. We're just sitting right at that level currently. So if we can get back up above and see some price action close above 1225, then that would be more of kind of a neutral bias on Ethereum. But if we do see Ethereum break down below that 1225 level, I think your bias has to be to the downside. And if we do see any kind of significant breakdown in the crypto markets, the downside target I've got targeted for Ethereum would be at this next anchor VWAP position, which is just below 900 on ETH. And then when we take a look at our total crypto market cap, so this is Bitcoin and all the crypto coins in the asset class, and we can see that we're chopping around sideways on this as well, currently sitting at about 772 billion on the total crypto market asset class. If we see some price action close below about 745 billion, then that could be a sign for the next leg lower in crypto, and so we'll be keeping a close eye on that one. Jumping over the S&P 500, mainly sideways price action this week on that after a bit of a sell-off the previous week. We did retest that down channel trend line and then ultimately sold off pretty aggressively the previous week, and now we've just really seen some kind of sideways price action this week. So the big question is, where do we go from here on the S&P 500? And I think what we're going to need to do is ultimately watch this price action closely and see where we head from here. I'll be looking for either a break above 385 or 390 to be looking for any kind of upside price momentum, but my bias is still tending towards the downside, and if we do see some price action close below about 377 or so, then we're likely going to be heading lower from there. Even if we do see any kind of a rally, there are people still wondering whether we'll get any seasonality strength with the Santa Claus rally going into year end. A lot of times we don't have a lot of volume those last couple of weeks of trading as well. So we potentially could see a bit of a rally. If we do, I don't think it'll be very strong or very long lasting. If we do get any kind of a bounce to the upside, I'd really just be looking for either a retest of the 200-day moving average, which is currently right around 400 on the SPY, or slightly above that would retest our down channel trend line that's been holding as resistance for the entire calendar year of 2022. So I think it's a pretty high probability bet that if we do get any kind of rally, it's likely only going to be up to between 390 and 400 or so on the SPY, and then we would likely head lower from there. So still, my bias for the markets is more bearish, and if we do get any kind of rally in this last year of the calendar year for 2022, then I'd most likely be looking for a further sell-off going into January of 2023. However, when we do look at breadth, there is some breadth indication measures here that could be suggesting some relative strength. We are seeing the S&P 500 stocks holding above 50% of them above their 50-day moving average, and we're also seeing that the number of stocks above their 200-day moving average got back up above 50% as well, and so that could potentially be signaling a bullish signal there for supporting potentially a Santa Claus rally going into year end. But as I said before, if we do get that, I think it'll be pretty short-lived and not a huge move to the upside either. And then we take a look at our NASDAQ. NASDAQ's looking worse than the S&P 500 and the Dow as well. And as long as we are below our 10-day EMA on this one, I'm going to continue to keep my short on the NASDAQ. Currently, my 10-day EMA is sitting at about 274 on the triple Q, so as long as we're below those levels, I'll be continuing to stay short on the NASDAQ. As if we do see any kind of a rally, just like in the S&P 500, I don't anticipate it to be super strong, or that it'll be a big move to the upside. If we did see a rally on the triple Qs, we'd be looking for a break back up above 270, and then maybe we'd retest that 282 or so, which is a Fibonacci extension level, and that would be my best guess for probably the end of that rally, and then we'd likely be headed lower from there. And then we take a look at Dow Jones Industrial Averages. It's definitely the best of the three indices right now. We've seen a couple of attempts at failing past the 50-day moving average. Really Thursday and Friday both. Thursday was really looking convincing, as we saw a pretty red day on Thursday, but then ultimately a lot of those losses gave them back before the close on the day. And so we've been holding above that 50-day moving average, which really is not much other way you can look at it than at least short-term bullish, as long as we're holding that. So that potentially also could be telling us that maybe we'll see a bit of a rally going into year end. If we do, though, I don't think we get above 343 on the DIA, and then I'd be definitely betting on heading lower from there. And if we obviously see a breakdown below the 50-day moving average, then that would just even be more bearish for, I think, the broader markets in general. When we take a look at our Dow Jones Transportation Index, while the Dow is actually above the 50-day, we can see the transports is below it. So we'd also like to probably see if you're looking for any kind of a bullish move going into the last week, you probably want to see that Dow Jones Transportation Index get above the 50-day as well, which is currently sitting at about 13,775. And if it doesn't get above those levels, then we're likely heading lower on the transports, and I'd be looking for a retest of the anchored VWAP position, which is currently sitting at about 12,460. We're going to take a look at a Russell 3000 chart. It looks like we just about tested that 200-week moving average, but not quite. And then ultimately, while we did see a little bit of selling pressure in the Russell 3000 this week and closed just a little bit lower, most of that selling was actually reversed, and we ultimately closed just about where we did the previous week on the Russell 3000. So again, kind of a neutral position there, and we'll want to see where that goes from here. We'd be looking for bulls would want to be looking for a break above that 150-week moving average, which is at about 2290, or if we do see a breakdown below that 200-week moving average, which is about 2150 currently on the Russell 3000, and I think that would be a pretty strong indicator that we're likely going to see the next leg down in the markets. And then looking at the Russell 1000, our large caps, chopping around between the 200-week moving average as well as the 150-week moving average. So we'll see if we get that Santa Claus rally going into next week. Maybe we'll get back up and retest that 150-week. I think best case scenario for any kind of a little bit stronger rally, maybe we get back up to 225, which is that 50-week moving average. But then I think it'd be a really high probability bet we'd roll over from there. And it wouldn't shock me if we didn't even get the rally next week and potentially go down and ultimately test that 200-week moving average, which is currently sitting at about 204 on the IWB. And then take a look at our small caps. Small caps look like they're potentially wanting to hold support right around this 173.50 level, which we've identified for quite some time as a pretty key area of support and resistance. So this is really kind of, we're going to need to see a definitive break up or break down out of this price level. If I'm looking for a move to the upside on small caps, I'd want to see a price action close above that 10-day EMA, which is at about 176 right now. Or if we're looking for further selling pressure on the small caps, we'd be looking for some price action to close back below that 173.50, and then ultimately close below some of these other closes, which is about 171, 172 on the IWM. And if we see price action break down from there, we'd likely see more selling pressure both in the markets as well as small caps, and potentially be looking for a test of that anchor VWAP position, which is about 162. And then take a look at our growth versus value. We did see growth and value kind of trading around relatively similar over the last few weeks. These are weekly candlesticks, and so we really haven't seen any massive change, although this week we did see a pretty big move to the downside, which is telling us that value was outperforming growth this last week. That would, I think, be a little bit more on the bearish side of things, because typically when we've had any kind of substantial rallies this year, we've generally seen growth start to outperform value for that brief period of time, whether it be a few weeks or a couple of months. Every one of those rallies we've had, essentially, we've seen a pretty good breakout in growth. And this last rally, it really kind of didn't break out, and it kind of went sideways, and now we're starting to see value outperform growth, which I don't think is necessarily a bullish sign for the markets based on how price actions react this year. And then take a look at our sectors that we track. This is for the last 5 trading days, so for the last week in the markets. We do have a lot better looking picture than the previous week. Almost everything was red going into the previous week recap that we did. We are seeing energy starting to show some strength. Not totally convinced that the energy trade is back on yet. Definitely think energy is going to be a great sector going into 2023, and there'll be some excellent trades there. But I'm actually looking for potentially a breakdown in oil prices, and we'll get into that chart here shortly. But if we do see that breakdown in the oil chart, then I think there's a decent chance we could see energy sell off a little bit more as well. So I'm being patient on this one, but it is nice to see that it's showing some relative strength on the week. We're also seeing some good strength out of steel, agriculture, and gold miners, as well as oil and gas exploration, metals and mining, and the silver trust, all up between 2 and 3% on the week. When we take a look at the worst performing sectors, natural gas still getting beat up really hard, down 20% on the week. And we're seeing cannabis down 10% on the week, ARC Innovation down 7%. Tesla's obviously been getting beaten up pretty hard recently, and ARC Innovation's been a big buyer of Tesla, and so Tesla's going down. A lot of times ARC Innovation is going down, and not to mention just in general, a lot of the ARC Innovation stocks have struggled a lot this year anyway, and so I've actually got a short on the ARC Innovation fund currently, and that's been working out pretty well. Also seeing global lithium underperforming 6.5%, self-driving EV and tech, cloud computing and solar, global auto index, and ARC FinTech all down between 4 and 6% as well. And then take a look at our oil chart that we talked about. We are just now up pressing against the 10-week EMA. So that's a pretty key area we can see as we've seen oil break down. We saw it break down below that 10-week and then ultimately below the 21-week EMA in the yellow line here. And ever since we've seen that breakdown, for the most part, we've seen price action stay below that 10-week EMA. We have seen a couple of little bumps back up above that level, but for the most part, we've seen most of the price action stay below that. So we'll be watching that one pretty closely, because that would be a pretty logical area for oil prices to turn around based off of this recent price action. And if we do see oil head lower, then I'd be looking for a retest of 70 again. And if that fails, then potentially see if we can ultimately get down to this 200-week moving average, which I still think is a pretty good chance could be potentially the bottom in the oil prices, and that's currently sitting just above 65 a barrel. However, if we do see oil prices break out, get above that 10-week EMA, and then I'd really want to probably see it get back up above 85. If we see oil break out above 85, then I think we need to seriously consider getting back into the energy trade. But for now, definitely unclear as to where the next move in oil prices are, and so I'm being cautious with the energy trade. As if we do see a capitulation in the markets and ultimately some selling pressure across most sectors, I think energy will be included in that. And so I think it's just there's too much risk right now to put on any energy trades at the moment until we see a little bit more definitive price action develop in the oil markets. And then take a look at our commodity index, the CRB. We've talked about this 267 level as being a huge area of support. And if we ever do see a breakdown below that level, I think that's going to be an excellent shorting opportunity down to that 243. But as we can see here, we've tested it multiple times. These are weekly candlesticks, and so we've had really about 5 weeks test those levels. And while we did get 1 week where it closed below the 267 level, then we had a pretty quick reversal going into the previous week. And then we ultimately moved up quite a bit higher this week as well. So still think that at best we're probably looking at sideways price action in the CRB index. I'd be pretty surprised if we broke up above that 50-week moving average, which is about 286. But it also doesn't really look like a very good short at this moment, because it looks like we're just kind of chopping up between 267 and about 285, 286 or so. So I want to see some price action break out of out of those price levels before we really have any biased direction on the CRB index. And then looking at our global charts minus the United States, we can see that we talked about retesting that 52 level, and as well as that 50-week moving average, and being as a potential area to top out in that last rally, and that's ultimately what we did. So it looks like we're heading lower from here. We'll see if we retest that 47.50 to the downside, or if we're looking for some bullish price action, we definitely want to see the global markets get back up above 52 if you're looking for any bullish trades in that space. And then take a look at our high-yield corporate bond index, our ETF. We are below the 75 level on this one, and we did have a failed breakout just the previous week. Oftentimes failed breakouts equal fast moves to the downside, and the HYG has oftentimes been a pretty strong indicator of market health as well. So if we do ultimately see the HYG break down from here, I think that would be another indicator that the markets are likely going to sell off again. But if we do see the HYG break back up above 75 and hold that as support, then that could potentially support the idea of a little bit of a rally in the market. So we'll be watching that one closely at the 75 level. And then take a look at our precious metals, starting out with gold. Gold looks like it's been on a bit of a tear recently. We bottomed out right around 150 on the GLD, and then had a pretty strong move up starting out at the beginning of November. And now it looks like we're kind of putting in what could be at least a short-term top in this one. Using some Elliott wave analysis, this looks like a pretty clear 5 waves up to me. We've got a wave 1 up with a brief little wave 2 correction, then another wave up for wave 3, and then our wave 4 correction. Then it looks like we've got our kind of 5th wave up, completing this wave move to the upside. And so what I'm kind of looking for from here is potentially a bit of a correction in gold, and I think we'd at least be looking for a 0.382 correction, which would be putting us at a corrective price target at about 162, 163 on the GLD, and a typical wave 2 correction for the next degree wave higher could potentially bring it all the way down to about 157, 158. So somewhere between about 157 and about 162, 163 would be kind of what I'm looking for a potential short-term correction in the gold prices. And if we do get that, then I'll definitely be a buyer there, because if we get that correction, then we're likely going to see that wave 3 up to the upside, and that could definitely represent anywhere from probably about 190 to maybe about 195 on the GLD, with that wave 3 up after that. So being patient on this one. I actually traded some gold and silver miner stocks on this first move up to the upside, as we saw a pretty big corrective move for most of 2022. But now it's starting to look like we're seeing a reversal, and I think gold and silver is definitely going to be one of the big sectors to keep your eye out for in 2023. So it's definitely an area that I'm pretty bullish on going into the next calendar year. But I think we need to be patient and potentially look for this next move to the downside and a corrective wave, and then we'll likely start to see some nice bullish momentum going into 2023. And then take a look at silver. It looks pretty similar. It looks like a pretty clear 5 waves up to complete our first wave to the upside, and then we'll likely be looking for that correction. So 0.382 would probably be what I'd be looking for in terms of minimum correction, which would put us back down to about 20 on the SLV. And if we get a 50% retracement, we're looking at about 1950, or if we get the 0.618 retracement, that would put us down to about 1885. So somewhere between about 1885 and 20 or so an ounce would be what I'm looking at for a correction on the silver prices. And if we get down to those levels, once again, just like with gold, I'll be a pretty aggressive buyer and likely be looking to re-enter some trades on potentially the metals themselves, as well as some of the gold and silver miners. And then take a look at our interest rates. Our US 2-year started to show some bullish momentum this week. Looks like it's putting in what might be at least a short-term floor right around the 4.2% on the 2-year. But I think there's also some pretty strong resistance at this 4.5 level, so we'll see how price action develops going into the next week or two. Would definitely be if we do get back up and retest 4.5. I think that's a pretty strong area of resistance, and that could potentially be the top in this move and then potentially head lower. I do think there's a strong possibility that at least on the longer term rates that the top's in. The 2-year potentially could get back up and retest where we got to. Maybe it could even get up to that 5% level. But I think at least on the longer term rates, there's a pretty good chance that the top is actually in. And taking a look at those 10-year rates, we did top out at about 4.35% on the 10-year, and we are definitely starting to see the 10-year move to the upside. We got a key area to watch on their 50-day moving average, which is about 3.82%. So that would be the first area of resistance I'm looking for to the upside, and see if we roll over from there. If we do break through the 50-day, then I'd be looking for a potential retest of the 4%, and that would also probably be another area of support that might be tough to get through. I think it's a pretty good chance that that 4.35% is ultimately going to be the top in the 10-year rates, and I think at the most kind of extreme level, I guess, to the upside would be potentially a retesting of the 4.35, but I'd be really surprised if we ultimately got back above 4.35 on the 10-year. I think there's a good chance the top is in on the rates, and I don't think the Fed is going to do too many more rate hikes. We might see one or two more early in the year next year, but I think we're getting a lot closer to the end of this rate hiking cycle, and I think ultimately these stock charts are kind of giving us a hint of that. So close the week out at about 3.75% on the 10-year. We saw a pretty strong price action out of 30-year. It's a pretty big move as we look at this. These are weekly candlesticks. There's not a lot of weeks here, going all the way back to the COVID lows where we saw this strong of a price action in the 30-year. So that's certainly something to keep an eye on, and definitely interesting. Looks like we've got above both of our 21-week as well as our 10-week EMAs, and so we'll be looking to see probably a retest of 4%, I would guess, on the 30-year, and then ultimately see where price action takes us from there. But that 4% could ultimately be a top on this next move to the upside on our 30-year, so we'll keep a close eye on that 4% level. And then take a look at our put to call ratios. We are back below 1. However, we did see some elevated put buy protection over the last couple of weeks with a lot of kind of fear and uncertainty in the markets, but ultimately we closed the week out below the 1 level line, which is typically in more normalized range. Anything above that 1.0 on this chart is typically elevated put buying protection, and we're not seeing that to at least close the week out. And then when we take a look at our dollar, looks to me like we might be putting a dollar bottom in on the dollar. It looks like we've got a couple of really strong areas of support to keep a close eye on. 103 was actually the peak in the dollar after we, right actually before the COVID crash, so that was at about 103 on the DXY. And then when we go back to about 2016 to early 2017, we ultimately topped out on the dollar at about 104. So 103 and 104 are some pretty key areas of support and resistance for the dollar, and we have ultimately tested that 104 level. We did see a little bit of we saw looks like one day of price action closed below that level, but then we saw a pretty big move to the upside. And now we're kind of chopping around between 104 and 105. So if we see a clear breakout of 105, then I think that's probably a sign that the dollar's going to start heading higher from here. But it looks like right now, at least, we're chopping around between the 104 and 105 level. And if we do lose 104, then I'd really be looking for that 103 to be a pretty big area of strong support. And then I'd likely expect the dollar to head higher. But I think there's definitely starting to look like this could be a bottoming formation going on in the dollar. And so I don't think there's going to be any big, huge drop out of the dollar from here. So we'll keep a close eye on that. And as long as we're above that 103, I think I'll be holding that opinion. If we do see a big drop in the dollar below that level, we could potentially retest the 100 on the DXY. But I don't think that's the most likely outcome, and so I'm watching 103 and 104 as really big, strong areas of support. When we take a look at our yield curves, our 10s minus 2s, actually, and as well as our 10-year minus 3-month, both are starting to move to the upside, and so we are starting to see the yield curve recover a bit, but we are still at historically negative readings. Our 10s minus 2s is at negative 0.576, and so even after a pretty big recovery over the last couple of weeks, we are still at historically negative readings on this one. When we scroll back, we can see going all the way back into the 20 teens that we've actually never seen the yield curve drop below that negative 0.5% level or so. So we're actually just getting back up to the worst it had ever been over the last few decades. And so still a lot of, I think, caution from this chart telling us that there's a good, strong chance of a recession. I don't think there's any way we can have historically negative readings on the yield curve charts like this and not have some sort of a negative outcome in the markets. And so I think this is still continuing to be a pretty strong warning for us going into 2023 to be cautious of some downside pressure in the markets. And then when we jump over to our VIX, VIX has been chopping around between 20 and 25, so really looking for a resolution out of this. If we see it drop below 20 and stay there, then that might indicate or give some support to the idea of a bit of a rally in the markets. But I think the most likely outcome is maybe we retest 20 one more time and then ultimately head higher from there. If we ultimately see the VIX break up above 25 and higher than that, then that would likely support would be most likely a breakdown in the markets, and we'd like to see some more selling pressure. Now let's go ahead and close it out with a stock chart of Apple on the week. So Apple's been a stock I've been watching pretty closely, not necessarily because I'm looking to trade it, but it is one of the largest market cap stocks in the stock market. And so oftentimes where Apple goes, the S&P goes, and so it's a good little cheat code to watch Apple closely to see potentially where the markets might head from here. So we've seen Apple hold support at about 129 for multiple time periods, and that's ultimately a Fibonacci extension level off of the pre-COVID crash highs, and so that's a pretty strong area of support and resistance at that 129 level. And so far, it's been acting as support and holding up the Apple stock above those levels. So watching that level really closely on Apple, and ultimately if we see Apple break down below 129, then I think that'll be a strong signal that we're likely going to see the market sell off further from there. But so far we've actually seen it hold the support. These are daily candlestick charts we're looking at, and we ultimately bounced just above that 129 level twice just this week, but we also went and retested that back in June as well when we had that sell off, and that was ultimately the start of our next rally. So definitely keeping a close eye on the Apple stock and watching that 129 level. How it reacts to that 129 level, I think will ultimately tell us where the broader markets are heading in the shorter term. Thanks for tuning in this week. Hope you guys all have a great holiday season and get some time off to spend with family and friends. And we will see you when we get back, diving into some chart analysis next week and close out the calendar year of 2022. It's certainly been a tough and interesting year in the markets, but I've certainly learned a lot. I think it's the tough markets where you actually become a lot stronger trader, because anybody can make money in bull markets. It really is the bear markets where you earn your stripes and become, I think, a pretty good trader. And so while I certainly haven't made a ton of money this year in the markets, it's been a great education, and definitely feel a lot more educated and stronger trader for it. So hope you guys learned some stuff too this year, and we will see you next time.